Well, thank you for attending this broadcast. I'm Tom Perone. This is Building and Protecting Your Business Worth. And today we're going to talk about how to keep key people with you and turn them into lifers. So, as a business owner, you can't do it all yourself. You need help. A middle management group, a middle management person, or key people, or the group is really the key. And by having them, you basically have increased the value of your company. Because if I'm a purchaser of your company in the future, chances are I really don't want to do what you're doing. I want to own the company and have people run it. Well, having that middle management in your company right now increases your multiples big time. So we're going to talk about retaining them, keeping them there. Remember, about 50% of employees are pretty happy. 20% are always going to be looking. But what I found out in my research was that about 91% of the people will tell you that compensation is in the top five reasons why they're there. And so as you go along as a business owner and build a culture and add more people, it becomes easier for hiring because people will see this culture and come to you, thus creating the opportunity of building middle management, people that will stay with you. So today, I'm going to show you a recording that I did that's about 16 minutes long about how to use a tool that will keep them there, reward them, but also allow you to recover your costs. So because of brevity, if you have any questions, please email them to me at tperone@necgginc.com. 203-530-6615 if you'd like to call me. But if you send me your question, I will get back to you, I promise. So sit back, listen to the video, and I'll be back with you in a moment. Welcome. Thanks for attending Building and Protecting Your Business Worth. I'm Tom Perone, and today it's all about retention. We're going to talk about retaining your key people because they are so valuable for your company down the road, not only if you are selling your business, but to make life easier for you. And when you transition, even to a point of being a passive owner, your key people are the people that run your business. So we're going to talk a lot about that because there's a lot at stake here. The first thing I think to understand is why executive retention matters. And one of the biggest things I can tell you, besides people helping you run your business, they become almost owners like you. They parrot you. They like their job. Usually there's a good culture. They are good workers, but it allows you to have a better transition in your business down the road, whether that's 30 years from now or not. Some statistics is that 50% of employees are really committed to staying. So you have a group that wants to stay, um, where the minority is kind of looking around and actively always seeking, and that's just going to happen anyways. But one of the stats that's important is the fact that you have 91% of the employees rank salary among the reasons they stay, the top five reasons. So with that, we want to talk about that because we want to be able to keep them, but we want to be able to keep them so that they stay longer, they're happy, and how we do that is basically using some kind of executive benefit, and they could be complicated, they could be simple. There are certain plans out there that you could use, like executive compensation bonus plans, executive bonus. And this is where you give the employee some money every year, and they can walk away with it if they want to. However, if they walk away, you just put out money, and now you not only put out money, you don't have a key person. So you try to put some kind of restrictions. And under the executive bonus plan that I know a lot of advisors use, the problem with that is that to keep a restriction, you either need a vesting schedule or you need a restricted agreement. Both get very messy at times for a couple of different reasons, which I won't get into it. So the business owner needs a real flexible plan to keep his employee happy, but also to protect him. So one of the solutions is that I like is to have a key man defined. The person you want to keep is also the person that's probably very loyal to you, very talented, and also potentially a candidate to be involved in the succession planning with you down the road. And we also want it to be cost recoverable and controlled by the employer. Cost recovery means if I give them a benefit, I get this benefit back and I recover it. And there's a way of doing that. So the key person, the goal is to protect the company from financial loss if the key employee dies, because it's going to cost money to go find that person. It's going to take quite a few people to find that person. So the business owns the life insurance. It's payable to the company. It's permanent life insurance. The policy death benefits and cash grow. It's basically a certain percentage of the employee's earnings or business value. And the death benefit help fund replacement costs and stabilize operations, meaning that upon the death of the key person, the employer gets a certain amount of that benefit to help replace that person, while also having to pay the benefit to that person's family. So for an example, an endorsement, SEEP, and retention bonus, the employer retains the ownership and the cost recovery. The employee's beneficiary receives a portion of the death benefit. So for an example, let's say you had a key person and they're putting in a 401k, and you put a $3 million key man policy on him. Upon his death, the company gets back a certain amount. Maybe they get $2 million back, but the employee's family gets the other $1 million tax-free, which costs the employee very little. It's very inexpensive. And that's a good benefit. Now, when he retires, let's say it's 65, the agreement is that he's going to get so much money. He's going to either get the cash value, the policy, whatever it might be that the agreement was made up with. Well, also part of that could be that the employer receives what they put in back, and the employee gets the rest. And so you can design it any way you want, but it's really a good way. It could be a very rich benefit so that people are staying longer because they don't want to miss out on such a good benefit. And it really does, it really creates a very good relationship because the employee key person is being treated differently, almost like the owner. And again, it can be skewed to be part of a buy and sell funding, both living and at death. So for an example, if the employee dies sooner than the event, there'll be a death benefit paid to the family tax-free. If he lives, he has the cash value of that policy, not only to walk away, but if he wanted to buy that company, that's his seed money down payment that he could possibly do. So there's a lot of opportunities with that. So when we see it in action, it looks something like this. Let's say we have a company that set up a 15-year plan for a top executive. Well, the policy provides protection between now and 15 years so that if they died, the family gets a big tax-free death benefit, probably much more than what they would have saved in their 401k. The executive is taxed on the they're being taxed on the death benefit, but it's a table one charge, very, very inexpensive. Um, you, the least expensive insurance you could buy. After 15 years, the company transfers the policy or pays a bonus. They could also set it up so that the company takes the cash and pays out a grossed up amount because they could pull a cash out tax free. So let's say they pulled $50,000 out tax free. Well, now they can afford to pay this guy $75,000 a year for 10, 15 years because the money is there to be used. So it's not coming out of cash flow or something like that. The employer can deduct the bonuses, and the executive gains long-term protection for his retirement. So it's a win-win on both parties. So the ideal people for this would be really key people that have kind of a meaningful feeling of the company. They want to stay. It could be tax and cost recovery. Very flexible as far as deposits, can be changed. The benefits of the control that the employer has and the cost recovery of it, and the fact that you can change things in it. That's the important thing. The executive, it really helps keep them because the executive knows they're in a position of being treated very differently on top of their 401k, which they're contributing to. Here's another layer of benefit that they can take out and have for retirement, their security of the future. So it's a very good benefit, and it's something that each employer should know more about. And again, these are plans that have been around for a long time. It's only been really the fact that product has been developed for the smaller market. At one time, this was very big with these public companies to keep their executives. But now with changes and design plans, even the smallest of companies can keep that key person. So I want to thank you for taking the time to listen. And if you have any questions, email me at tperrone, TPERRONE, at necgginc.com, or call me at 203-530-6615. Thanks so much for taking the time. Well, there you go. The smallest company needs a key person. The largest company needs a group. So if you're going to invest in these key people, spend a lot of money, a lot of time, a lot of training, put together a way of keeping them there, or at least having the odds. And I've always said this, that if your key person is that good, your competition knows who they are. And if your competition has deeper pockets than you, there's a good chance that that key person might be approached. You don't want to lose them. So sometimes having a long-term benefit that he can't duplicate anywhere else is worth the time. So again, thank you. Again, you have to contact me, TPERRONE at NECGGINC, 203-530-6615. I'm Tom Perrone. Thanks so much for taking the time.